Lastly, I analyzed the logistics industry. We have air transport, which operates worldwide cargo and charters for the express package industry and freight forwarders, as well as for the United States Department of Defense and the automotive industry. It also wet leases aircraft, and recently Amazon announced in 2016 that it will use air transport for the transportation of prime services. So that's going to be hopefully a good deal for them. FedEx Corporation is an American multinational courier delivery services company. In 2017, the company launched a new branch called FedEx Fulfillment, a logistics network for small and medium sized businesses. Ryder is a Fortune 500 American provider of transportation and supply chain management products. They're especially known for their fleet of rental trucks. UPS, or United Parcel Service, is an American multinational package delivery company and a provider of supply chain management solutions. UPS was the only company in the industry that made two acquisitions in 2017, which were successful. XPO Logistics is a U.S. corporation and one of the world's 10 largest providers of transportation and logistics services. They turned their first ever profits in 2016 due to mergers and acquisitions. Short-term solvency leverage ratios, short-term solvency and liquidity ratios for this industry. So let's see here. Even though their cash ratio is below 1, FedEx has the most consistently high cash ratio above the industry average. XPO had a spike in short-term solvency in year 2, most likely due to mergers and acquisitions taking place in 2015 as well as 16. Ryder has the least ability to pay off short-term debt, as well as all of their liquidity ratios are below 1. And we like FedEx the most because they can most consistently pay off their short-term liabilities. Long-term solvency, now leverage. UPS clearly has the highest and most increasing debt in the industry, and in 2015, when they really started using their leverage, they were able to pay off their debt about 23 times over. However, in more recent years, their debt is increasing at a substantial rate, but they're still maintaining their ability to pay it off, which we like. Overall, we can see that companies in this industry, on average, have gotten more debt over the past few years, but their ability to pay it off basically either remains the same or increases for a few companies. Asset efficiency. UPS is more efficient than the other companies in utilizing their assets, and it has been the most consistent over the past 5 years, which we like to see. Profit margin and return on assets. We like UPS because their profit margin is consistently the highest over the past 5 years. It is also in correlation with their return on assets trend. We can see that their high ROA is driven by profit margin and that they use their assets wisely. XPO had recent upward trends in total asset turnover and ROA, again likely due to their acquisitions in the past. Ryder is just recently doing well, but we don't like that they use their assets wisely, so we like them less. Return on equity. We like UPS because they consistently have the highest ROE in the industry. However, their ROE tripled in 2017 because of leverage. We know it's leverage because their equity multiplier also significantly increased over the last 2 years. However, their EBIT margin is also increasing, and in the last 2 years, their EBIT margin is the highest compared to other companies in the industry. We also like FedEx because they're consistent with their leverage, is their consistent ability to pay it off. They have consistent tax and interest burdens, so we know that their ROE increase for the past 2 years is driven by operating efficiently and using their assets wisely. Market value for this industry. We can see that the market sees recent potential in air transportation, but it may be overvalued since they don't actually add much value to their company since 2014. UPS is also liked by the market. The market consistently sees potential in UPS over the last 5 years, but UPS may also be overvalued because their market to book ratio is way above average. Free cash flows. UPS has historically had the most cash flows until 2017. This is because their pension and retirement contributions more than tripled for 2017, so they had to pay all that money back into those accounts. Supply chain, we like UPS because they have the most suppliers and the most customers. We can see that they have the least risk in supply compared to the other companies based on their diversity. Analyst recommends that we can expect large growth on an industry-wide scale due to the increasing trend in online retail. The increased consumer demand to have products shipped directly to your home calls for increased transportation, which is good for this industry. Also, we have a goods and service tax that has helped these logistic companies to make the last mile for shipping goods smoother and also to help them curb costs that they can tax the products that they're transporting. The industry winner for logistics is UPS. We like them because they have the most debt, but they also have the highest and increasing ability to pay it off almost 23 times over. They are consistently managing their assets above the industry average. They have the highest profit margin. Their expected potential correlates with their consistent price to earnings ratio. They add significant value to their company since 2014. And they have the largest supply chain in the industry, meaning that they're a less risky choice to invest in. My overall winner across all three industries is McKesson. It was difficult in choosing the firm I liked overall due to the different company sizes and the different nature of the industry structures. However, based on the expected industry performance and growth potential, I chose McKesson because they use their assets wisely, added the most value to their company within the last year, and they have increasing returns on equity. The medical technology industry is also centered on technological innovation, which is expected to continue rising in the future, creating growth potential for companies in this industry. So McKesson operates efficiently and they can afford the debt they have. With the expected rise in the future, they should be pretty profitable. McKesson will continue being an industry leader because they focus their business model on innovation through mergers and acquisitions as well as internal growth. So their business strategy is also a little diversified, which is why I chose them as well.